You know that feeling when you're driving down the highway?
Oh.
Right? And suddenly the check engine light just pings on.
Oh, yeah. The bright yellow light of doom staring right at you.
Exactly. It's warning you that something fundamental is failing under the hood. But, I mean, you have somewhere to be. You're running late.
So you just keep driving.
You just keep driving. You maybe turn the radio up a little louder to, drown out any weird rattling sounds, and you just hope for the best.
Right.
And then, like a few days later, the light randomly turns off. You didn't take the car to a mechanic. You didn't do anything. It just switched off.
And your immediate reaction is to just tell yourself, well, the car magically fixed itself. Problem solved.
Which is a genuinely terrifying assumption to make about a 2-ton machine going 70 miles an hour, right?
It's completely irrational. I mean, the underlying mechanical failure didn't just vanish into thin air. The sensor just stopped screaming at you.
Right. The engine is still fundamentally compromised, but you have this illusion of safety back. So, welcome to our deep dive. Today, we are looking at how the entire global financial market is essentially driving down that highway right now.
Yeah, cheering because the check engine light turned off.
Exactly. Cheering while completely ignoring the smoke starting to pour out of the tailpipe. We're custom tailoring this exploration around a really fascinating financial strategy note from the Sovereign Dispatcher.
Dated June 28, 2026.
Right, June 28, 2026. And the brief is titled, The Fiscal Counterweight. Our mission today for you, the listener, is to unpack a very specific, very dangerous psychological trap that's currently playing out in global markets.
The source calls it deferral wearing the costume of a verdict.
Deferral wearing the costume of a verdict, which is just a brilliant way to phrase it.
It really captures the exact dynamic we are seeing across multiple continents right now. The market is actively rewarding itself for confusion, honestly.
Because they're looking at these major unresolved postponements decisions that have basically just been delayed, and investors are treating them as actual structural resolutions.
Yeah, the Sovereign Dispatcher refers to this whole phenomenon as the 60-day assumption.
The 60-day assumption, which honestly sounds like a polite way of saying investors have the memory of a goldfish.
Pretty much. I mean, the premise seems to be that because the dollar is currently sitting near like a one-year high, the market is collectively hallucinating.
Hallucinating that all the massive structural risks from the last quarter have just been cleared away by administrators.
Right. People look at that strong dollar and they take it as an absolute sign of strength and global stability. But if you dig into the mechanics underneath, that relief is entirely borrowed.
It's borrowed.
It's totally borrowed. The market is pricing in this best-case scenario where every single open question just magically settles in the investor's favor.
They're trading on the assumption that a postponed risk is a canceled risk.
Exactly. Which is incredibly dangerous.
So, to understand how a supposed settled assumption gets completely upended, we have to start at the foundation of global market plumbing. We need to talk about Japan.
We do. Because the so-called permanent funding floor that the entire global market relies on was just blown wide open.
Okay, so to fully grasp why Japan's domestic policy actually matters to you, the listener, we need to walk through how Japan anchors something called the yen carry trade.
Right, the yen carry trade. It's basically the invisible engine of global market liquidity.
So how does that actually work in practice?
Well, historically, interest rates in Japan have been incredibly low, like virtually zero or even negative for a really long time.
Right.
So if you are an institutional investor, you can borrow billions of yen, essentially, for free.
Okay.
And then you take that cheap, borrowed Japanese money, you convert it, and you invest it in higher-yielding, much riskier assets in frontier markets.
So you might buy, like, government bonds in Egypt or Ethiopia that pay out 7 or 10%.
Exactly. And you pocket the difference. Japan basically acts as the global discount lender. They single-handedly fund the rest of the world's risky bets.
But that mechanism only works if Japan's interest rates stay near zero, right?
Right. Any movement upward in Japan's rates sends immediate shockwaves through the entire global financial system.
Because the cost of borrowing goes up.
Exactly. Which means all those risky bets in emerging markets suddenly become unprofitable.
Triggering massive sell-offs.
Yeah. And this brings us to the first major contradiction the Sovereign Dispatcher highlights. The Bank of Japan, the BOJ, they just raise interest rates to a full 1%.
Which is wild.
Yep.
Because usually a central bank only raises interest rates to cool down an overheating economy and fight inflation.
Right.
But Japan's core inflation for May was actually below their target.
Yeah, they didn't have an inflation fire to put out at all, so the domestic economic logic for raising rates is highly contested.
But the source points out some really crucial, impartial political context here. The U.S. Treasury Secretary Bessent was heavily pushing for this hike.
Yeah, the Nikkei even dubbed him the shadow governor.
It's a shadow governor, wow.
And the international dynamics there are fascinating. And, we aren't taking a side on whether that external political pressure from the United States is justified or not.
All right, we're just reporting what the source material is highlighting.
Exactly. But the reality the market has to digest is that the rate hike happened against the grain of Japan's own domestic economic data. The Bank of Japan forced this tightening measure through anyway.
And then, just days later, literally days later, Japan's Prime Minister Takaichi announced the country's largest ever fiscal roadmap.
A massive roadmap. We are talking about a $2.3 trillion public and private investment plan.
Spread over the next 14 years.
Yes.
And the government is funding this huge spending spree by issuing a flood of new Japanese government bonds.
New JGBs, exactly.
So wait, the central bank is tightening the money supply by raising rates, but the government is unleashing $2.3 trillion in new spending.
It's completely contradictory.
Isn't that like trying to cool down a room with the air conditioning on full blast while simultaneously lighting a massive bonfire in the middle of the floor?
That is the perfect analogy. The International Monetary Fund assumed Japan would pair its monetary normalization with fiscal consolidation.
Meaning they expected the government to tighten its belt while the central bank tightened the money supply.
Right, so the two instruments would work in harmony. But instead, Japan is pulling its economic levers in completely opposite directions.
Because all those new government bonds being issued to pay for the bonfire, they have to be absorbed by the market.
And a massive supply of new bonds puts upward pressure on bond yields.
And if Japanese bond yields go up, the cost of that yen carry trade we talked about skyrockets.
Right. Suddenly, the cheap money funding all those frontier markets isn't cheap anymore. The foundation of global liquidity starts cracking.
So the Bank of Japan is now caught in a vicious trap of its own making.
Totally. If the Prime Minister's massive bond issuance forces yields too high, the central bank might be forced to step back into the market and buy those bonds.
To cap the yields and absorb the supply.
Right. But if the central bank starts buying bonds and pumping money back into the system to cap yields,
they completely undo the rate hike they just painfully pushed through.
Exactly. They would reloosen the policy they just tightened. The funding floor that everyone thought was permanent and stable is actually highly volatile right now.
But investors are pricing these frontier market bonds as if the Japanese funding cost is a settled, reliable mathematical equation.
Yes. And the sovereign dispatcher points out that this is no longer a monetary variable at all. Investors are now pricing a highly unpredictable political variable.
They are assuming a verdict has been reached when in reality the jury is actively fighting in the deliberation room.
That's exactly it. That is a perfect example of a verdict actively contradicting itself.
So let's move to our second scenario. This is where the absolute absence of a verdict is mistakenly being cheered as the absence of risk.
Right. We are heading to Indonesia.
Indonesia. So Indonesia gives us a textbook example of the market seeing the check engine light turn off and just assuming the engine is fixed.
It really does. So the major stock market index provider, MSCI, had been reviewing Indonesia for a potential downgrade from its emerging market classification.
And to give you, the listener, some context on MSCI, they aren't just an analyst firm. They are the gatekeepers of trillions of dollars in passive investment capital.
Huge amounts of money. When MSCI classifies a country, passive index funds are basically contractually obligated to allocate money there.
So if MSCI downgrades Indonesia, it forces those massive index funds to automatically sell off their Indonesian assets, whether they want to or not.
Right. It would be a brutal forced capital flight.
But MSCI didn't downgrade them.
No, they didn't. But they also didn't clear them.
Right.
They simply deferred the decision. They asked Jakarta for further evidence of market reforms. They suspended the verdict indefinitely.
And the market threw an absolute party over this delay.
Oh, massive relief rally.
And we should add that Indonesia had already aggressively raised its interest rates by 100 basis points in just 6 weeks to defend its currency and market position.
And for the listener, a basis point is 0.01%.
Right, so 100 basis points is a full 1% rate hike. Doing that in just 6 weeks is basically a central bank slamming on the emergency brakes.
They were desperate.
Yeah. So when MSCI delayed the downgrade, investors treated that deferral as a massive victory.
But the trapdoor hasn't been closed at all. It is simply suspended by a thread. To keep its emerging market classification and avoid the inevitable downgrade, Jakarta actually has to implement specific reforms.
Right. MSCI demands that they increase transparency and impose larger free float requirements.
Yeah. Let's define free float so we have a clear picture.
Okay, yeah. Free float refers to the percentage of a company's total shares that are actually available to be traded by the public on the open market.
Right, rather than being locked up by corporate founders, insiders, or governments.
So MSCI wants more shares available to trade so the market has more liquidity.
Exactly. But the Sovereign Dispatcher's Note outlines a completely bizarre paradox here.
The cure might actually be the disease.
Yeah. If Jakarta forces these strict transparency and free float rules on their companies to satisfy MSCI, analysts are warning about some severe unintended consequences.
Like what?
Well, those stringent requirements might push major Indonesian companies to decide the regulatory hassle simply isn't worth it.
So instead of floating more shares, they might choose to delist from the public market entirely and just go private.
Exactly. Reforming the market to retain the free float could actually cause the country to lose its free float entirely.
Wow. It shrinks the investable universe even further. I mean, how does an investor even begin to price a situation where compliance triggers the exact capital flight you were trying to prevent?
The short answer is they price it incorrectly, or they just ignore it.
Right.
The source identifies this as the suspension premium.
The suspension premium.
Yeah. Because there is no clean resolution that doesn't cost Jakarta either its index classification or its market float, uncertainty is quietly building up on every single Indonesian asset.
Because passive money, those massive index funds, cannot position themselves for a review when there is no set date for the verdict.
Right. Meanwhile, the active money managers are just dismissing the extreme tail risk.
Tail risk being the probability of a rare catastrophic event, like an overnight downgrade, triggering a massive forced sell-off.
Right. They discount it simply because it hasn't happened yet. The risk is compounding quietly in suspension.
It is a deferred verdict masquerading as a favorable one.
Exactly. And the Sovereign Dispatcher is extremely cautious on Indonesia across its entire capital structure for this exact reason. The market is pricing in the relief of a delay without pricing in the actual mechanics of the eventual settlement.
Just like celebrating that the mechanic didn't look at your car today.
While the engine is actively seizing up, yeah.
Okay, so we've seen how postponed verdicts distort reality in Japan and Indonesia. Let's look at two neighboring frontier credits handling this uncertainty in drastically different ways.
We have one country borrowing a verdict and another country manufacturing its own.
Right. Let's look at the borrowed piece first. Pakistan.
So Pakistan represents what the source terms the proxy in its purest form.
Okay.
It is a sovereign nation attempting to secure relief for its balance of payments without actually fixing its own internal fiscal discipline.
And for anyone unfamiliar with the term, think of the balance of payments as a country's international checking account.
Right.
It tracks all the money flowing in from exports and investments versus the money flowing out to pay for imports and debt. When that balance goes negative, the checking account is bleeding dry.
Bleeding out fast. And Pakistan's elites are trying to get an external bailout to refill that account rather than cutting up their own national credit cards.
They are pinning their economic survival entirely on geopolitics.
Entirely. The government's strategy hinges on their army chief's diplomatic push to broker a settlement between the United States and Iran.
The bet is that if Pakistan facilitates diplomatic goodwill in the region, it will somehow unlock a massive influx of financial support from Washington, the Gulf states, or multilateral organizations.
But the market is currently pricing in financing that hasn't been secured based on a peace deal that doesn't actually exist on paper yet.
It's completely unsigned.
Unsigned.
Yeah.
And even if they miraculously sign a treaty tomorrow, the physical logistical realities are daunting.
Because the source points out that part of the assumed deal involves reopening the Strait of Hormuz.
Right. And you can't just declare a heavily mined waterway open by signing a piece of paper.
Obviously not.
The physical process of deploying ships, scanning the seafloor, and demining the strait takes 30 days minimum.
And during every single one of those 30 days, Pakistan's energy import bills continue to relentlessly drain their dwindling foreign reserves.
The physical supply of energy has to normalize before the financial bleeding stops.
But the market is ignoring that gap. They're ignoring the gap between a diplomatic signature and the actual logistical execution.
Yeah, so while Pakistan is betting the mortgage payment on a lottery ticket that hasn't even been printed yet, the risk becomes entirely binary.
Binary meaning if the diplomatic deal happens and the logistics hold, they get a massive inflow of cash.
Right. But if the negotiations stall for even a few weeks, they hit a dense wall of debt maturity with absolutely no backup plan.
Zero backup plan.
None. The sovereign dispatcher sees deep asymmetry in Pakistan for this exact reason. The upside is already priced in, but the downside of a stall is being completely ignored.
Okay, now let's contrast that borrowed piece with India.
Right. India isn't waiting around for a geopolitical verdict to save them. They scheduled their own verdicts.
India's just showing up to work and clocking in.
Yeah. They entered July with highly concrete manufactured catalysts.
Like they have a finalized UK trade deal officially taking effect.
And they have a massive IPO pipeline going live, specifically the Geo listing.
And Geo is a titan in the Indian telecom and tech space. Bringing a behemoth like that to the public market brings in billions of dollars of real, verifiable capital.
Real capital. These are concrete signals of structural confidence. You do not see that level of scheduled, heavyweight corporate activity if capital is actively fleeing the country.
And the source applies this same constructive logic to the broader North Asian tech corridor too, right?
They do. They prefer these manufactured catalysts over generic commodities. The report specifically points to South Korea's SK Hynix, a global semiconductor giant, planning a $29 billion U.S. listing.
Wow, $29 billion.
Yeah, and it also highlights Singapore showing a massive 38% surge in exports.
So these aren't hopes or diplomatic proxies. These are hard numbers hitting the ledger.
Hard numbers. Though I will say the sovereign dispatcher does issue a warning to respect the froth in some of these markets.
Froth meaning it might be a little overvalued in spots.
Right. They point out record Korean equity volatility and pockets of property mania that investors shouldn't blindly chase.
But the overall contrast is stark. I mean, the only major unmanaged risk the source identifies for India right now is a late monsoon season.
Which really highlights how different the risk profiles are.
Because nearly half the Indian workforce is employed in agriculture.
Right. So a normal monsoon season waters the crops, supports rural economic demand, and actually validates the central bank's currency defense.
But a failed monsoon turns food inflation into a nightmare, forcing the central bank into a corner on interest rates.
Exactly. But think about it. India's risk is a single weather variable built on top of a foundation of concrete trade deals and massive corporate listings.
Whereas Pakistan's risk is betting their entire financial survival on an unsigned international peace treaty.
Exactly. In a richly priced global market, concrete scheduled catalysts are infinitely safer than betting on diplomatic goodwill to substitute for actual fiscal discipline.
A manufactured verdict beats a borrowed one every time.
Every single time.
So bringing this deep dive full circle, as you listen to this, think about how this dynamic plays out in your own everyday life.
Oh, it happens all the time.
Right. How often do we delay a really hard conversation or put off a difficult career or relationship decision and then walk away feeling a sense of genuine relief?
We mistake the delay of the problem for the actual solution to the problem.
Exactly. In our personal lives, it's just human nature. But in global markets, that psychological quirk has a multi-billion-dollar price tag.
It is the suspension premium. The most expensive error an investor can make in sovereign credit is not misreading a verdict.
It's mistaking a postponed verdict for a favorable one.
Exactly. The market is incredibly richly priced right now. But underneath that shiny surface, nothing is actually settled.
The Bank of Japan's carry floor is actively being contested by its own government's spending bonfire.
The Iran financing for Pakistan is promised, but it hasn't been wired to the bank.
And Indonesia's MSCI downgrade is merely suspended, not dismissed.
Right. Interest on a deferred risk is always paid by the person foolish enough to believe the matter was closed.
The bill doesn't arrive when a bad verdict is finally delivered.
No, the bill arrives on the morning. The market wakes up and discovers the favorable verdict it had already priced in was never actually going to happen.
You have to price the variance, not just the headline.
Always.
Which leaves us with a final, lingering thought to chew on. We talked at the beginning about that check engine light.
Yeah, driving down the highway.
Right. We know the global financial plumbing is currently balancing on this grand illusion that all these delayed verdicts in Japan, in Indonesia, and Pakistan will eventually just break in the market's favor.
So ask yourself, what happens to the entire emerging market structure when the car finally stalls on the highway?
What happens on the morning the market realizes the engine is seized, the mechanic is closed, and the relief we've been trading on for the last 60 days was nothing but borrowed time?
That is the settlement that never came. And as the dispatcher makes clear, that is the one that costs the most.
Keep your eyes on the dashboard. Thanks for joining us on this deep dive.